The Perpetual Investor, Mastering the Inner Game of Wealth. Part 1. The Inner Game. Why Wealth Begins in the Mind. Every investor wants better returns, more consistency, and more confidence. But the truth is simple. The real battle isn't in the stock market, real estate, or any asset. The real battle is internal. The investors who succeed decade after decade aren't the ones who know everything. They're the ones who know themselves. The perpetual investor is not defined by luck, timing, or a perfect strategy. They are defined by behavior, discipline, and emotional control. They understand that wealth is built by a person who can think clearly when everyone else is panicking, stay patient when others chase trends, and stick to a plan when the world is full of noise. This first part sets the foundation. You are not just learning how to invest. You are learning how to become the person capable of building long-term wealth. The real reason most investors fail. Most investors don't fail because the markets are difficult. They fail because they cannot control themselves. They let fear push them to sell too early. They let excitement push them to buy too late. They copy what everyone else is doing. They jump from idea to idea. When you look at the world's most successful long-term investors, there is a pattern. They master the emotional game before they master the financial game. They understand that every decision is shaped by psychology. Your fears of losing, your desire to be right, your impatience for fast results, your overconfidence after a win. Until you understand these impulses, they will control you. True wealth builders don't eliminate emotions. They learn how to work around them. The power of identity-based investing. Your behavior always follows your identity. If you say, "I want to invest like a disciplined investor," you will fail. If you say, "I am a disciplined investor," your actions begin to match that identity. The perpetual investor thinks in decades, not days. They see money as a tool, not a trophy. They make decisions based on principles, not trends. And most importantly, they don't outsource responsibility. They own everything. When you shift your identity, consistency no longer feels forced. It becomes natural. The patience advantage. The world praises speed, but wealth rewards patience. Most people try to force results, chase shortcuts, and look for the next big thing. The perpetual investor plays a different game. They know that wealth is a compounding process, not a lottery. Patience multiplies money because it keeps you invested long enough to benefit from compound growth. It keeps you from jumping in and out. It keeps you focused on what matters. Patience protects your wealth as much as it builds it. Mastering your emotional operating system. You have an internal operating system, habits of thinking, patterns of reacting, and emotional triggers. If you don't bring this system under control, you will always sabotage your progress. The perpetual investor builds emotional systems, such as the ability to pause before acting, the discipline to follow a plan, the skill to analyze without panic, the confidence to ignore noise, the humility to stay a student. These mental tools are more valuable than any investment strategy. Long-term thinking as a superpower. Short-term thinking creates stress, anxiety, and bad decisions. Long-term thinking creates clarity, confidence, and steady growth. When you think long-term, daily fluctuations stop mattering. Market dips become opportunities. Boring consistency becomes your advantage. You stop comparing yourself to others. You make decisions that protect your future. Wealth is built by daily habits repeated over decades, not by dramatic, emotional moves. The perpetual investor mindset. The mindset you are building is defined by 3 core ideas. Control yourself, not the market. You can't control returns. You can control your behavior. Think in decades, not weeks. Big results require long time horizons. Let compounding work, uninterrupted. Interruptions, not market losses, destroy wealth. Once you adopt these principles, you stop fighting the market and start using time as your greatest asset. Your first assignment. Before you move into strategies, systems, and practical tools, you need clarity. Write down what kind of investor you want to become, what long-term wealth means to you, the behaviors you know have been holding you back, the identity you want to step into. Clarity is the beginning of discipline, and discipline is the beginning of wealth. Part 2, Rule 1. Build a foundation of consistency. Every great investor eventually learns that consistency is more powerful than intelligence, luck, timing, or market predictions. Consistency is the quiet force behind every fortune, the habit that compounds into wealth, and the discipline that protects you from destructive mistakes. If Part 1 made you understand that wealth begins within you, this part is about creating the foundation that makes long-term wealth inevitable. The perpetual investor does not rely on motivation. Motivation is unstable. It comes and goes. They rely instead on routines, principles, and systems that keep them showing up even when they don't feel like it. Consistency is a decision that becomes a lifestyle. Why consistency beats brilliance. Many people with incredible knowledge never build real wealth. They study endlessly, jump from strategy to strategy, and consume massive amounts of information but fail to apply it. Their results collapse because they have no structure guiding their actions. They act emotionally instead of systematically. Meanwhile, the investor who simply invests a fixed percentage of their income every month, avoids emotional decisions, and follows a long-term plan will outperform the emotionally unstable genius every single time. Consistency multiplies results because it smooths out volatility. It eliminates panic-driven decisions. It lets compound interest work uninterrupted. It builds emotional resilience. It turns wealth building into a habit, not an event. Long-term wealth is not built by extraordinary moves. It is built by ordinary actions repeated every day. The myth of perfect timing. Most new investors waste years waiting for the perfect moment to start. They hesitate when the market is high. They hesitate when the market is low. They hesitate when the news is good. They hesitate when the news is bad. In their mind, the ideal entry point is always a few days away. This belief destroys more wealth than bad investments ever will. The perpetual investor understands that time in the market matters far more than timing the market. You are not trying to catch the absolute bottom or avoid every drop. You are trying to build wealth over 10, 20, 30 years. The one who waits for perfection never starts. The one who starts consistently always wins. Automating the wealth-building process. One of the greatest strengths of a perpetual investor is automation. When your investing habits are automated, emotions stop interfering with your decisions. You remove the biggest risk to your financial growth, yourself. Automation reinforces consistency by making saving and investing non-negotiable, eliminating overthinking, reducing emotional reactions to market swings, preventing lifestyle inflation, ensuring you're always building wealth in the background. You should strive to create a system where money moves into your investments before you ever get the chance to spend it. Wealth is not built with leftover money. It is built with prioritized money. Automation protects your goals from your impulses. Building a non-negotiable money habit. A perpetual investor does not invest when they feel like it. They invest because it is part of who they are. They treat investing as seriously as brushing their teeth or showing up for work. It is a non-negotiable. To build a non-negotiable money habit, choose one number. A percentage of your income that will be invested every month no matter what. It doesn't need to be huge. What matters is the habit. Once the habit strengthens, the percentage can grow naturally. You are not trying to impress anyone with large contributions. You are building a lifelong system. Start small. Stay consistent. Increase slowly. Grow forever. The emotional gap between knowing and doing. You already know that you should save. You already know that investing early is powerful. You already know that discipline creates wealth. But knowledge alone rarely changes behavior. The emotional gap, the space between knowing something intellectually and doing it consistently, is where most people lose the game. Consistency closes that gap. It trains your emotional system to align with your long-term goals instead of your short-term feelings. Every time you follow through, even when you don't feel like it, you strengthen your identity as a disciplined investor. Every consistent action rewires your beliefs. Every routine deposits confidence into your mind. Identity is built through repetition. What consistency looks like in real life. Consistency is not dramatic. It is not glamorous. It is not loud. Most of your wealth-building moments will be quiet evenings with spreadsheets, simple transfers, reviewing your goals, and sticking to your plan. Consistency looks like investing during good markets and bad markets, not reacting to trends or rumors, choosing a long-term plan over short-term excitement, letting boredom be your advantage, staying focused when others are distracted. Most people crave excitement, and that craving sabotages their future. You must become comfortable with the boring parts of wealth. The calm, the waiting, the discipline. Consistency thrives in the quiet spaces where impatience dies. The truth about boredom. Boredom is the silent killer of wealth. People abandon great strategies not because they fail, but because they feel slow. They want dramatic growth. They want fast results. They want emotional stimulation. But the perpetual investor understands that boredom is a sign of a stable, effective system. When your investing becomes so automatic that it feels uneventful, that is when wealth begins to accelerate. Boredom is not a flaw. It is evidence that you are no longer sabotaging yourself. Eliminating the start-stop pattern. Most people start strong, lose consistency, stop, restart, stop again, and never build momentum. They exhaust themselves with constant resets. The start-stop pattern is the enemy of compounding. You eliminate this pattern by reducing friction in your money habits, automating key decisions, tracking progress visually, reviewing your plan monthly, predicting obstacles in advance, making decisions ahead of time. You must become the person who always follows through, not occasionally when it feels good, but repeatedly until it becomes natural. Decide who you are becoming. Consistency is not just about what you do. It is about who you are becoming. You are no longer someone who invests when possible. You are becoming someone who invests because it is essential to your life mission. A perpetual investor is defined by long-term direction, routine execution, and an identity rooted in discipline. This is your new standard. Before moving forward, write down your non-negotiable monthly investing habit. Choose a percentage. Choose a date each month or an automated transfer. Make it your identity. When you master consistency, everything else becomes easier. Part 3, Rule 2. Master the emotional game of money. If consistency is the foundation of wealth, emotional mastery is the shield that protects everything you build. The markets do not destroy most people's financial lives. Their emotions do. Fear makes people sell too soon, greed makes them buy too late, and impatience makes them abandon strategies that would have made them rich if they had simply endured. The perpetual investor understands that wealth is an emotional journey long before it is a financial one. You are not just battling market cycles. You are battling the parts of yourself that panic, overreact, rush, doubt, procrastinate, and crave certainty. Part 3 is about learning to control those inner forces so you can make clear, rational, long-term decisions even when the world around you feels chaotic. Why emotional control is more valuable than market knowledge. You can study technical analysis, valuation metrics, stock history, and economic cycles for years. But none of it matters if you cannot control your reactions during pressure. Emotional discipline is the skill that separates the wealthy from everyone else. Emotional discipline makes you hold during temporary declines, stay committed during uncertainty, avoid panic selling, Prevent destructive, impulsive buying. Stay rational in irrational environments. Follow your strategy when your feelings disagree. Money does not respond to your emotions. It responds to your behavior. The most successful investors do not have supernatural intelligence. They have emotional endurance. They stay calm when others lose their minds. They trust data more than headlines. They allow time to work instead of fighting it. Understanding fear. Fear is the strongest financial emotion because it activates deeply rooted survival instincts. When the market drops, your brain reads it as danger. Your body produces stress responses. Suddenly, logical risk becomes emotional catastrophe. Fear causes people to sell at the bottom, hoard cash, avoid long-term investing, seek safe strategies that sabotage returns, believe that short-term volatility equals permanent loss. The perpetual investor responds differently. They understand that temporary declines are part of the game. They accept volatility as the price of admission. They remain grounded in long-term data instead of short-term noise. You must learn to identify the difference between actual danger and emotional discomfort. Wealth grows in the space between those two. Understanding greed. Greed is the emotional opposite of fear, yet it destroys wealth just as effectively. Greed whispers that you should chase trends, jump on hype, double down on risky bets, and seek unrealistic returns. Greed pushes you toward impulsive action instead of strategic action. Greed makes people chase bubbles, jump into investments they don't understand, overestimate their skill, take reckless risks, ignore red flags, abandon their long-term plan for excitement. The perpetual investor recognizes greed early. It usually shows up as impatience, the desire to grow faster, make bigger moves, or copy someone else's success. But wealth built through greed is unstable. Wealth built through discipline is permanent. Understanding impatience. Impatience is the silent killer of long-term thinking. Many dreams die because people simply refuse to wait. They want wealth fast, not wealth forever. Impatience leads to constant strategy hopping, selling winners too early, investing inconsistently, doubting proven systems, expecting progress on unrealistic timelines. Impatience is rooted in a misunderstanding of compounding. Compounding is slow at first, frustratingly slow. But once it reaches the tipping point, growth becomes exponential. The wealthy endure the slow years so they can enjoy the explosive ones, creating emotional distance between you and your money. The perpetual investor learns to create a healthy psychological distance from their investments. They are not emotionally attached to short-term outcomes. Their self-worth does not rise and fall with market movements. They do not obsessively check performance, and they never react to the noise of financial media. To create emotional distance, reduce how often you check your investments. Rely on data, not drama. Base decisions on principles, not feelings. Focus on long-term goals rather than short-term performance. Build confidence in your strategy before committing money. When you detach emotionally, you can focus on what you can control: contributions, discipline, and patience. The power of non-reactivity. Most people respond instantly to fear, uncertainty, or excitement. They react because they feel uncomfortable sitting with emotion. The perpetual investor develops the ability to sit calmly with discomfort. They do not react immediately. Instead, they pause. They evaluate. They return to their system. Non-reactivity gives you space to think rationally. It protects you from destructive impulses. It reinforces your identity as someone who operates on principles, not emotions. Almost every major financial mistake can be traced back to a moment of emotional reactivity. Installing emotional checkpoints. Before making any money decision, create checkpoints that force you to think clearly. These checkpoints could be questions such as, does this align with my long-term strategy? Am I reacting emotionally or logically? Will this decision matter in 5 years? Am I being influenced by fear, greed, or impatience? What does the data actually say? These checkpoints slow down emotional decisions and upgrade them into strategic ones. Replacing emotion with process. A process protects you when your emotions don't. That is why the perpetual investor builds routines, rules, and habits that become the default mode of operation. When the world becomes chaotic, they fall back on their systems. An emotional investor asks, "What should I do right now?" A perpetual investor says, "I will do what I always do." Your process should tell you how often you invest, what you invest in, how you react to volatility, how you evaluate changes, when you rebalance, when you stay still. Emotion thrives in uncertainty. Process eliminates uncertainty. Training emotional resilience. Emotional resilience is not natural. It is trained through experience and reflection. Every time you make a calm decision during volatility, you strengthen your mental endurance. Every time you stick to your plan while others panic, you reinforce your identity. You build resilience by reviewing your wins, studying past mistakes, learning market history, observing long-term trends, practicing patience, reducing exposure to emotional triggers. Over time, the market stops intimidating you. You become grounded, stable, predictable in your habits, and wealth rewards the predictable. The mindset transformation. To master the emotional game, you must accept one truth. Markets will rise, fall, and fluctuate unpredictably, but your behavior must remain steady. Your calm must be stronger than the noise. Your patience must be longer than the cycles. Your discipline must be deeper than your fear. This is what separates temporary investors from perpetual ones. When you master emotion, you become unshakable. Part 4. Building the internal framework of a perpetual investor. A perpetual investor is not defined by luck, talent, or timing. They are defined by the structure that governs how they think, decide, and act with their money. Wealth doesn't grow because of impulses, moods, or random decisions. It grows because of systems. Inside every financially successful person is an invisible framework that keeps them grounded, disciplined, and consistent, even when the world around them shifts. This part focuses on building that internal architecture, your personal operating system for long-term wealth. Money becomes easier to grow when your mind is built to handle wealth. A wealth mindset built on stability, not emotion. Most people experience money emotionally. They feel excited during bull markets and fearful during downturns. They jump into trends late and panic sell early. Their financial lives are tied to their emotional fluctuations. And because emotions are unstable, their wealth becomes unstable too. Perpetual investors operate differently. They anchor their financial decisions to principles, not feelings. They rely on systems, not impulses. They expect ups and downs, so neither surprises them. Their calmness is built from understanding, not blind hope. Emotional investing destroys consistency. Principle-based investing builds it. Your job is to shift from emotional reactions to disciplined responses. This shift turns wealth building from chaos into strategy. Adopting a long-term orientation. A perpetual investor is always thinking beyond the present moment. They build habits that pay off over decades, not weeks. They avoid the mental trap of thinking in short bursts. Short-term investors ask, "Is this going to go up next month?" Long-term investors ask, "Is this asset worth owning for years, even if the price fluctuates?" Short-term thinkers get shaken out of opportunities. Long-term thinkers stay the course and enjoy compounding. To develop this internal long-term lens. 1. Delay gratification by default. If it does not grow you, it can wait. 2. Evaluate choices through a 10-year filter. Ask, will this matter or grow in a decade? 3. Build rituals that support patience. Autopilot investing, scheduled reviews, and periodic rebalancing anchor your long-term focus. When the orientation shifts, your results follow. Building your personal investor identity. Identity drives behavior. If you see yourself as bad with money, your actions will reflect that belief. If you see yourself as someone who is disciplined, strategic, and patient, your habits automatically align with that identity. You become the investor you believe you are. Constructing a powerful investor identity begins with intentional design. You are someone who makes decisions based on data, not emotion. You are someone who invests consistently, regardless of market noise. You are someone who values long-term rewards over short-term excitement. You are someone who treats every dollar as a seed, not spending money. You are someone who learns, improves, adjusts, and evolves. Identity is not about perfection. It's about direction. When you anchor yourself to the identity of a perpetual investor, the discipline becomes natural, strengthening your mental toughness around wealth. Money will test you. Markets will drop. Plans will fail. Cash flow will tighten. Opportunities will take patience before they grow. Anyone can be disciplined when things are easy. Real wealth requires being disciplined when things are difficult. Mental toughness means you don't quit during market downturns. You don't chase hype or get pulled into financial noise. You stay focused on your plan, not the crowd. You manage risk intelligently instead of avoiding risk entirely. You rely on strategy, not hope. You build mental strength through deliberate practice. 1. Exposure to discomfort. Watching your investments fluctuate teaches emotional resilience. 2. Committing to consistent contributions. Automatic investing trains discipline. 3. Staying educated. The more you understand, the less you fear. Mental toughness is the bridge that allows you to walk from intention to outcome, mastering expected cycles instead of fearing them. Wealth moves in cycles: expansion, contraction, recovery, growth. Most people panic in contractions and get greedy in expansions. Perpetual investors expect cycles. They understand that downturns are a normal part of long-term growth, not signs to retreat. Instead of panicking, they ask, how can this cycle serve my long-term advantage? During downturns, assets become affordable. During booms, discipline prevents overexposure. In recoveries, patience is rewarded. Every cycle has a strategic role. Once you accept cycles as natural, fear disappears. What remains is focus. Developing a strategic decision-making process. Perpetual investors don't rely on luck. They rely on a repeatable process that guides their choices. This process keeps them grounded when emotions run high. A strong decision-making system includes 1. Clarity. What is the purpose of this investment? 2. Risk assessment. Can you afford to lose or wait on this capital? 3. Time horizon. Is this aligned with your long-term plan? 4. Diversification. Does this fit into a balanced portfolio? 5. Evidence. Are you acting on research or hype? Systems eliminate impulse. Impulse destroys wealth. The more consistent your decision framework, the more consistent your results. Eliminating financial self-sabotage. Self-sabotage is the quiet enemy of wealth. It shows up through habits that look small in the moment, but accumulate into long-term losses. Overtrading, chasing quick returns, emotional spending, avoiding financial tracking, ignoring risk, copying others instead of building your own plan. To eliminate self-sabotage, you must attack the root. Lack of clarity leads to emotional choices. Lack of discipline leads to inconsistency. Lack of structure leads to chaos. Lack of identity leads to self-doubt. When you install the right internal framework, self-sabotage becomes harder and wealth building becomes easier. The unbreakable rules of a perpetual investor. To remain grounded, adopt these rules as part of your internal system. Rule 1. Never rely on emotion for financial decisions. Emotion leads to inconsistency. Rule 2. Always think in decades, not weeks. Time is your biggest advantage. Rule 3. Automate the predictable parts of your financial life. Consistency beats intensity. Rule 4. Diversify across assets and time horizons. This protects you from volatility. Rule 5. Prioritize learning over earning in the beginning. Knowledge compounds faster than money. Rule 6. Protect your downside before chasing the upside. Survival is the first rule of wealth. These rules shape your inner architecture, making you steady, rational, and prepared for long-term success. Your internal system creates your external wealth. Wealth is not built by accident. It is built through alignment, your beliefs, habits, decisions, and strategies working together consistently. When your internal framework is controlled, structured, and disciplined, your financial outcomes follow naturally. This part of the book gives you the mental foundation to make your money grow perpetually. From here, the next step is mastering the habits and systems that translate your mindset into measurable results. Part 5. The habits that create lifetime wealth. Building wealth is not a dramatic event. It's the quiet accumulation of thousands of disciplined choices made over long periods of time. Perpetual investors don't become wealthy because they know everything. They become wealthy because they repeat the right habits long enough for compounding to take over. This part of the book focuses on installing those habits, daily, weekly, and monthly behaviors that silently grow your net worth. The goal is simple. Replace randomness with routine and replace emotional decisions with repeatable systems. Wealth becomes a natural byproduct of well-designed habits. Why habits are more powerful than motivation. Motivation fades. Enthusiasm fluctuates. But habits, once installed, run on autopilot. They don't require inspiration or mood. They don't depend on how your day went. They become a default way of operating. Perpetual investors understand that. Motivation gets you started. Discipline keeps you consistent. Habits make your discipline automatic. If you rely on motivation to invest, save, budget, or learn, your financial progress will always fluctuate. When habits take over, your progress becomes consistent, predictable, and compounding. Habit number 1. Paying yourself first. This is the foundational habit of wealth. Before spending, before bills, before lifestyle choices, money is directed toward building your future. This habit shapes your identity. You become someone who prioritizes wealth over impulse. Paying yourself first creates automatic savings, continuous investing, emotional detachment from market timing, a long-term focus on growth. Start with any amount. What matters is repetition. Small contributions that grow into large outcomes through time and compounding. Habit number 2. Automating your investments. Automation transforms wealth building from a decision into a default. It eliminates hesitation, fear, and emotional interference. By scheduling investments, you ensure consistency, even when markets move unpredictably. Automation helps you invest during highs and lows. Avoid panic buying or panic selling. Maintain dollar-cost averaging. Stay committed without relying on willpower. Every perpetual investor uses automation because it protects them from themselves and from the emotional storms of the market. Habit number 3. Tracking your money without obsession. Wealth requires awareness. You cannot control what you don't measure. Tracking your money is not about strict budgeting or limiting joy. It's about clarity. You need visibility into your inflows, outflows, and investment progress. Track enough to stay aligned, but not so obsessively that the process becomes exhausting. The goal is long-term consistency, not perfection. A perpetual investor observes trends, behaviors, and patterns and adjusts accordingly. Habit number 4. Consuming financial education daily. Knowledge compounds just like money. A single insight can save you from a massive financial mistake. A single strategy can accelerate your growth by years. Perpetual investors treat learning as a lifelong habit. Commit to reading financial articles, studying investment principles, listening to wealth-building audiobooks, understanding asset classes, learning from investors with proven track records. This habit sharpens your mindset, improves your decision-making, and strengthens your confidence during volatile times. Habit number 5. Separating emotion from action. Wealth requires emotional discipline. Markets will fluctuate. News will alarm you. Friends will hype up trends. Social pressure will tempt you. Without emotional separation, you become reactive. And reactive investors rarely build wealth. Train yourself to observe without reacting. Pause before acting. Question the impulse. Analyze objectively. Discipline strengthens each time you avoid an emotional decision. Over time, rationality becomes your natural state. Habit number 6. Living below your means to live above your future. This habit is not about deprivation. It's about intentionality. Perpetual investors do not let lifestyle creep outpace their wealth building. They maintain a lifestyle that supports their long-term goals, not one that drains them. Living below your means gives you more money to invest, less financial stress, freedom from debt, flexibility during downturns, a growing sense of control. The less you need, the more powerful you become. Simplicity accelerates wealth. Habit number 7. Building cash buffers and emergency reserves. True investors do not invest recklessly. They build a strong foundation first. This means having cash reserves to protect against unexpected events, income fluctuations, or emergencies. A proper cash buffer prevents forced selling, emotional reactions, debt accumulation, financial panic. With safety in place, you can invest confidently, not fearfully. A stable base creates a stable mind. Habit number 8. Reviewing and adjusting quarterly. Wealth requires adaptation. Markets shift. Income evolves. Opportunities appear. Risks change. You cannot set your financial plan once and ignore it forever. Perpetual investors refine their systems through scheduled reviews. A quarterly review includes checking asset allocation, rebalancing if needed, updating financial goals, evaluating cash flow trends, adjusting contributions. These small, intentional adjustments prevent drift and keep your long-term strategy aligned. Habit number 9. Limiting financial noise. Most people fail financially not because they lack skill, but because they are overwhelmed by noise, opinions, predictions, trends, and social pressure. Noise triggers fear and excitement, both of which distort decision-making. Perpetual investors intentionally limit news cycles, social media hype, trend-chasing conversations, short-term predictions. They focus on what matters: principles, history, and long-term patterns. Noise distracts, discipline directs. Habit number 10. Thinking in systems, not decisions. Wealth doesn't come from a single great decision. It comes from installing a system that consistently makes good decisions for you. Systems include routines, automations, rules, frameworks, and behaviors that operate with minimal effort. Examples of systems: automatic investment contributions, monthly wealth audits, spending rules aligned with goals, risk assessment frameworks, preset emergency fund thresholds. Systems turn consistency into something effortless. A system can make you wealthy even on an average income. Habit number 11. Protecting your time and attention. Your mind is your greatest financial asset. Distractions dilute it. Noise drains it. Unproductive activities steal your focus from growth. Perpetual investors guard their time carefully. Protecting your time includes reducing low-value commitments, prioritizing learning, creating dedicated financial planning time, blocking distractions during important tasks. Focus is a form of wealth. It multiplies everything else you do. Habit number 12. Surrounding yourself with financially smart environments. Your environment shapes your habits more than willpower ever will. A wealthy environment reinforces wealthy behavior. A chaotic environment reinforces chaotic results. Your environment can include people you learn from, content you consume, systems you install, routines you maintain, spaces where you work or plan. Surround yourself with wealth-minded influences, and you will naturally start thinking and acting like someone who builds wealth. Wealth is a habit, not an event. Nothing about wealth is accidental. Every outcome is rooted in a habit. Your financial life reflects what you repeatedly do, not what you occasionally intend. Perpetual investors embrace this truth. Small, disciplined habits create large, inevitable results. Once the right habits are installed, wealth stops being a struggle and becomes a natural progression. Part 6. The Patience Principle. Why Time Makes You Unstoppable. If there is one skill that separates perpetual investors from everyone else, it is patience. Not talent, not luck, not timing. Patience. Wealth is rarely built through speed. It is built through endurance, consistency, and the willingness to let time multiply your efforts. Most people fail financially not because they are incapable, but because they quit too early. They interrupt compounding. They chase excitement. They abandon long-term, thinking the moment short-term discomfort appears. But those who master patience become financially unstoppable. This part of the book dives into the patience principle, the mental and emotional foundation that makes compounding work for you instead of against you. Why time is your greatest advantage. Time has more influence over your wealth than any investment strategy, stock pick, or interest rate. What you earn matters. What you invest matters. But how long you stay invested matters even more. The power of time lies in the exponential curve. The early years feel slow. Progress seems invisible. Growth looks flat. But with enough time, the curve suddenly bends upward and accelerates. Most people never witness this acceleration because they give up before it happens. They look at the early years and assume it will always be slow. They underestimate the speed of compounding. Perpetual investors do the opposite. They respect time. They trust the curve. They stay long enough to experience the part where growth becomes explosive. Why impatience destroys wealth. Impatience leads people into emotional decisions that sabotage their financial progress. They chase trend after trend, strategy after strategy, hoping for faster results. They compare their journey to others and feel behind. They panic when markets drop and get greedy when markets rise. Impatience blinds you to long-term success because it makes short-term discomfort feel unbearable. And this is a trap. All meaningful wealth requires moving through periods that don't feel good. Declines, corrections, boring stretches, stagnation, volatility. Without patience, these moments feel like failures. With patience, they become stepping stones. Impatience makes you reactive. Patience makes you strategic. The emotional side of long-term investing. Patience isn't just a strategy, it's emotional mastery. When you invest for the long term, you face real psychological challenges. You feel uncertainty. You see temporary losses. You question your decisions. If you don't understand your emotional responses, you will panic at the exact moments that require calm. Perpetual investors train their emotional resilience. They learn to sit with discomfort. They learn to separate temporary volatility from permanent loss. They understand that the market moves in cycles and that downturns are normal, expected, and temporary. Patience grows stronger when you see market drops not as threats, but as natural parts of the journey. How patience protects you from emotional mistakes. Every investor faces emotional traps. Fear of missing out. Fear of loss. Overconfidence during bull markets. Panic during bear markets. Urges to time the market. Impulses to follow the crowd. Patience acts like a shield. It slows your reactions. It forces you to think long-term. It reminds you that short-term movement has little influence on long-term outcomes. When you are patient, you don't feel pressure to predict the future or react to noise. You trust your system. You rely on your principles. You make decisions based on logic, not emotion. When patience becomes your default state, your risk of making costly mistakes drops dramatically. Long-term thinking turns setbacks into advantages. Here is the truth almost nobody understands. Downturns are gifts to long-term investors. Corrections give you lower prices. Volatility gives you better entries. Bear markets give you years of discounted assets. Most investors avoid these moments. Perpetual investors welcome them. They understand that the best returns often come from buying in uncomfortable periods. Patience allows you to endure these moments while others panic. It allows you to see opportunity where others see danger. It prevents you from being swept up in emotional waves that push people into poor decisions. When you adopt long-term thinking, you realize that setbacks are not setbacks. They are stepping stones to larger gains. The identity shift, becoming a patient investor. Patience is not an act. It is an identity. You become patient through repetition, through experience, through self-reflection, through seeing the rewards of staying the course. The identity of a patient investor sounds like this. I understand that wealth takes time. I refuse to be rushed by trends. I do not react to short-term noise. I trust the long-term rewards of discipline. I let compounding do its work. Once this identity is internalized, your behavior naturally aligns with long-term thinking. You stop chasing what is urgent and start committing to what is meaningful. Slow progress is still progress. One of the biggest reasons people abandon their financial journey is the illusion that nothing is happening. Early progress feels small. Savings grow slowly. Investments barely move. Yet these slow beginnings are the foundation for everything that comes later. Small growth is not failure. It is preparation. The compounding curve always starts slow. Always. But every contribution, every month of consistency, every day of patience builds into unstoppable momentum. You cannot skip the slow part. You must push through it. The reward is exponential growth later. How patience strengthens your future. Being patient today gives your future self incredible advantages. More time in the market, more cycles of compounding, more resilience, more opportunities, more financial peace, more freedom. When you are patient, you unlock benefits that people who rush will never experience. Every dollar invested with patience is worth more than a dollar invested with urgency. Every decision made with patience is more strategic. Every setback navigated patiently becomes a source of future profit. Patience doesn't delay your success, it multiplies it. Your wealth grows when you learn to wait. Waiting is not passive. It is active discipline. It is choosing not to interrupt compounding. It is choosing not to panic. It is choosing not to chase trends. It is choosing not to sabotage your own progress. Waiting is a skill, and the better you get at it, the wealthier you become. Patience is the quiet force behind every wealthy person you admire. It is the hidden advantage behind their results. It is the foundation beneath every fortune. This is why perpetual investors win. They stay long enough to let time work for them. Part 7. Building unshakable confidence in your financial decisions. Confidence is one of the most misunderstood elements of wealth. Most people believe confidence comes from already having money. But perpetual investors know the truth. Confidence is what creates the money. It is the internal belief that your decisions are sound, your strategy is solid, and your long-term vision is worth committing to. Confidence is not arrogance. It is not carelessness. It is not blind optimism. Confidence is the quiet stability that keeps you grounded while the world around you swings between fear and frenzy. It is the inner certainty that protects you from emotional decisions and keeps you focused on long-term goals. In this part of the book, we explore how to build unshakable confidence in your financial decisions. Confidence rooted in clarity, knowledge, discipline, and long-term thinking. Why most people lack financial confidence. Most people struggle financially not because they are incapable of learning, but because they never build enough confidence to trust their own judgment. They constantly doubt themselves. They copy others. They jump from strategy to strategy. They panic when the market moves against them. They rely heavily on external opinions rather than cultivating internal clarity. Without confidence, every financial decision feels risky. Every dip feels like a threat. Every opportunity feels overwhelming. A person without confidence is easily influenced, easily discouraged, and easily manipulated by trends, opinions, and noise. Confidence doesn't eliminate uncertainty, but it gives you the strength to move through uncertainty without being consumed by fear. The foundation of financial confidence: understanding your system. The strongest confidence comes from clarity. When you know exactly why you're investing, how you're investing, and what principles guide your decisions, half the fear disappears immediately. Wealthy investors are confident because they have systems. They can explain their decisions. They understand risk. They know how long their strategy requires. A system turns chaos into structure. It turns uncertainty into opportunity. When you follow a system, you don't need to rely on emotion or guesswork. You act based on a framework, not impulse. Confidence grows every time you see your system work. It grows every time you stay consistent. It grows every time you choose discipline over reaction. Why confidence must be built, not borrowed. Many people try to borrow confidence from experts, influencers, or friends. But borrowed confidence collapses the moment life tests you. If you rely solely on someone else's opinion, then the moment they express doubt, you lose stability. If you rely on market predictions, then the moment the prediction fails, you feel lost. If you rely on hype, then the moment the excitement fades, you panic. True confidence is internal. It comes from your knowledge, your decisions, your patience, and your experience. It is the confidence you build from seeing yourself stay disciplined, from seeing yourself improve, from seeing yourself react with more calm than last year. Borrowed confidence is temporary. Internal confidence is permanent. Confidence comes from repetition. Repetition strengthens belief. Just as an athlete builds skill through repeated practice, an investor builds confidence through repeated decisions. Decisions grounded in principles, not emotions. Every time you invest consistently, your belief in your system grows. Every time you stay calm during volatility, your emotional resilience strengthens. Every time you witness compounding working, your commitment deepens. Confidence doesn't grow from one big win. It grows from many small, disciplined wins over time. Repetition is what transforms investing from something that feels intimidating into something that feels normal. How confidence keeps you from being shaken by others. When you are confident, other people's opinions lose their power over you. You no longer feel pressured to follow trends. You no longer feel the urge to justify your decisions. You stop comparing yourself to people who appear more successful. You stop being swayed by fear-filled headlines or market predictions. The moment you develop internal confidence, you stop needing the world to approve of your choices. You become immune to the noise that drives most investors into emotional chaos. Confident investors do not chase. Confident investors do not panic. Confident investors do not react impulsively. They have clarity, and clarity creates stability. The confidence gap, what separates the wealthy from everyone else. There is a noticeable gap between perpetual investors and the average person. It is not income. It is not background. It is not intelligence. It is confidence. Wealthy individuals understand that uncertainty is part of the game. They understand that volatility is natural. They understand that temporary declines are not the end of the world. Because they are confident, they remain steady while others crumble. They see opportunity where others see danger. They continue investing while others freeze. Confidence is the difference between staying in the game long enough to win and stepping out prematurely because fear became too loud. Confidence comes from knowing your why. Your financial confidence strengthens dramatically when your reasons are clear. If you know exactly why you want wealth, freedom, security, impact, stability, legacy, then short-term discomfort becomes easier to endure. When your why is strong, your discipline becomes stronger. Your patience becomes stronger. Your resilience becomes stronger. A weak why creates weak decisions. A strong why creates unshakable decisions. Perpetual investors reconnect with their why often. It keeps them grounded. It prevents emotional drift. It keeps their eyes on the future instead of getting lost in short-term noise. Confidence requires emotional honesty. You cannot build confidence if you lie to yourself about your weaknesses. If you pretend you're calm when you're not. If you ignore your fears. If you avoid learning what you do not understand. True confidence requires emotional honesty. This means acknowledging when you feel uncertain, confused, overwhelmed, or scared, without letting those emotions control you. It means asking questions when you need clarity. It means admitting when you acted impulsively, then learning from it rather than hiding from it. Emotional honesty creates improvement. Improvement creates confidence. The identity of a confident investor. The perpetual investor eventually becomes someone who trusts their own ability to make good financial choices. They don't need applause to stay committed. They don't need reassurance to continue investing. They don't need external validation to feel secure. Confidence is part of their identity. It is built into how they think. It influences how they respond to money. It shapes how they lead their life. It makes them resistant to emotional swings that destabilize others. This identity doesn't happen instantly. It forms through experience, patience, repetition, knowledge, and self-discipline. But once it forms, it becomes one of the most valuable assets a person can ever possess. Confidence makes you a perpetual investor. Perpetual investing requires long-term commitment. It requires consistency. It requires patience. It requires discipline. And most importantly, it requires confidence. Without confidence, you will always be tempted to second-guess yourself. You will always be at risk of abandoning your plan. You will always be vulnerable to emotional reactions. But with confidence, you become calm, stable, consistent, and forward-focused. You become the type of investor who stays long enough to win. You become someone who benefits from compounding instead of interrupting it. You become someone who moves steadily toward financial independence. Confidence makes you resilient. Confidence makes you strategic. Confidence makes you unstoppable. Part 8. In this part, we focus on strategic risk management and emotional control, which are essential components for mastering the inner game of wealth. Investing is not only about identifying opportunities. It is equally about protecting capital, managing emotions, and making rational decisions under pressure. Understanding risk in investing. Every investment carries some degree of risk. The goal is not to avoid risk entirely, but to understand, manage, and strategically leverage it. Key principles of risk management include assessing risk-reward ratios. Every opportunity should be evaluated based on potential returns versus possible losses. Higher returns often come with higher risk, but disciplined analysis ensures informed decisions. Diversification. Spreading investments across assets, industries, and geographies reduces exposure to any single failure. Liquidity considerations. Maintaining access to cash or easily liquidated assets prevents forced selling in unfavorable conditions. Margin of safety. Always invest conservatively relative to your knowledge, research, and resources, creating a buffer against uncertainty. Emotional control in investing. Emotions can be the biggest barrier to consistent wealth building. Common emotional pitfalls include fear, avoiding opportunities due to fear of loss; greed, chasing high returns without proper analysis; overconfidence, taking excessive risks after early wins; impatience, selling prematurely due to market fluctuations. Techniques to maintain emotional control. Set clear investment rules. Define entry and exit points, risk limits, and criteria for evaluating opportunities. Automate decisions where possible. Use predetermined systems, recurring investments, or robo-advisors to remove impulsive actions. Regular reflection. Journaling or reviewing past decisions helps identify emotional triggers and patterns. Meditation and mindfulness. Cultivating calm and clarity reduces reactive decisions influenced by market volatility. The Perpetual Investor's approach. The Perpetual Investor balances aggressive growth with protective strategies, creating a long-term sustainable approach. Identify opportunities aligned with personal knowledge, skills, and goals. Allocate resources with diversification and margin of safety in mind. Execute decisions according to well-defined rules, not impulses. Review performance, learn from mistakes, and adjust strategies continuously. Case study: emotional discipline in action. Consider James, an investor early in his career. He initially chased hot stocks, reacting to market hype. Losses mounted and frustration grew. After adopting a disciplined approach with clear rules, diversification, and reflective practices, James stabilized his portfolio. Over time, his calm, methodical approach allowed him to take calculated risks, achieve steady returns, and grow confidence as a perpetual investor. James's experience demonstrates that emotional control amplifies the effectiveness of financial strategies. Practical strategies for readers. Develop a risk assessment framework. Before any investment, evaluate potential outcomes, probability of success, and worst-case scenarios. Create a diversified portfolio. Balance stocks, bonds, real estate, and alternative assets to reduce vulnerability. Implement stop-loss measures. Protect capital by defining limits for losses and gains. Use gradual scaling. Start with small positions in new opportunities and increase allocation only as confidence and knowledge grow. Maintain continuous education. Understanding market dynamics, economic indicators, and investment vehicles reduces uncertainty and emotional reactions. Key takeaways. Risk is inherent in investing, but strategic management transforms it into opportunity. Emotional discipline ensures decisions are rational, consistent, and aligned with long-term goals. Diversification, liquidity management, and margin of safety protect capital. Reflection, journaling, and mindfulness strengthen emotional control. A perpetual investor balances growth and protection, creating sustainable wealth over time. By mastering risk management and emotional control, you move closer to becoming a perpetual investor, someone capable of navigating markets confidently, strategically, and successfully over the long term. Part 9. In this part, we focus on the role of patience and timing in building lasting wealth. The perpetual investor understands that success is rarely instantaneous. Markets fluctuate, opportunities come and go, and emotional impulses can sabotage progress. Mastering patience and timing is essential for both preserving capital and maximizing returns. Why patience is critical. Patience is the ability to wait strategically while maintaining focus on long-term objectives. In investing, impatience often leads to premature exits from profitable positions, impulse purchases based on hype or fear, short-term thinking that undermines wealth accumulation. Perpetual investors recognize that compounding works best over time, and that enduring short-term volatility is part of the path to long-term success. Timing versus predicting. Many aspiring investors attempt to predict markets, thinking they can buy low and sell high perfectly. However, perfect timing is nearly impossible. Instead, focus on strategic timing. Use historical patterns, research, and data to guide decisions rather than relying on luck or instinct alone. Positioning for the long term. Invest in assets that are likely to grow over years, not days. Incremental investments. Spread out purchases over time to reduce exposure to short-term volatility, a strategy often called dollar cost averaging. Avoiding emotional decisions. Emotional reactions to short-term market movements are the biggest threats to timing. Stick to strategy and rules. The power of compounding. Patience unlocks the exponential power of compounding. Financial compounding. Earnings generate further earnings when reinvested consistently over time. Knowledge compounding. Learning and experience grow cumulatively, enabling smarter decisions and higher returns in the future. Network compounding. Relationships with mentors, advisors, and peers expand opportunities and insights, compounding social and strategic advantages. The perpetual investor leverages patience to allow these forms of compounding to accumulate, producing extraordinary results over the long term. Practical strategies for patience. Set clear long-term goals. Knowing exactly what you are working toward reduces the need for impulsive action. Track progress, not perfection. Focus on incremental growth and improvement rather than expecting immediate results. Create decision-making rules. Predefined entry, exit, and risk parameters minimize reactionary mistakes. Practice mindfulness. Techniques like meditation, reflection, or journaling strengthen your ability to stay calm during market fluctuations. Celebrate milestones, not short-term wins. Recognizing meaningful progress reinforces patience without tempting you to act on every market movement. Case study. Timing and patience in action. Consider Emily, an investor focused on long-term growth. She began investing in a diversified portfolio with consistent monthly contributions. Early in her journey, market downturns tempted her to sell out of fear. By following her predefined strategy, she held her positions, and over several years, market recoveries and compounding resulted in substantial growth. Patience, combined with discipline and strategic timing, allowed Emily to transform modest investments into significant wealth. Emily's experience shows that staying the course and acting strategically over time consistently outperforms reactionary, short-term decisions. Common mistakes to avoid. Chasing trends. Jumping into popular assets without proper research is rarely profitable long-term. selling during downturns. Panic selling locks in losses and prevents compounding benefits. Overtrading. Frequent trading increases costs, taxes, and emotional stress without guaranteeing better returns. Neglecting portfolio review. While patience is key, periodic strategic reviews ensure alignment with goals and adaptation to changing conditions. Key takeaways. Patience is foundational for compounding, wealth accumulation, and emotional stability. Timing should be strategic, not based on guesswork or emotion. Long-term focus, incremental investing, and disciplined adherence to strategy maximize results. Market volatility is inevitable. Calm, informed action protects capital and amplifies growth. By mastering patience and timing, the perpetual investor achieves sustainable wealth growth with minimal stress and maximal consistency. Patience and timing transform ordinary investors into perpetual investors capable of navigating markets, growing wealth steadily, and maintaining confidence through every economic cycle. Part 10. In this part, we focus on continuous learning and adaptation, which separates average investors from perpetual investors. Financial markets, technologies, and global economies are constantly evolving. To maintain and grow wealth over decades, you must cultivate a mindset of lifelong learning and adaptability. The importance of continuous learning. Wealth is not a static goal, it is dynamic. Strategies that worked yesterday may not work tomorrow. Continuous learning allows investors to stay ahead of market trends. Being informed enables you to anticipate shifts and take advantage of opportunities rather than reacting after the fact. Refine skills. Investing is as much a skill as it is knowledge. Practice, experience, and learning from mistakes enhance decision-making over time. Mitigate risk. Knowledge reduces uncertainty. Understanding asset classes, economic cycles, and investment principles allows for more confident, lower-risk decisions. Capitalize on innovation. Technological advancements create new investment opportunities, from fintech solutions to emerging industries. Staying informed allows you to leverage these trends. Developing a learning mindset. Perpetual investors adopt several habits that foster continuous growth. Read widely. Books, journals, and reputable financial publications expand knowledge. Focus on both practical strategies and theoretical understanding. Seek mentorship and networks. Learning from experienced investors accelerates understanding and exposes you to insights you might not discover alone. Analyze past decisions. Reflection on successes and failures creates actionable lessons for future investments. Experiment strategically. Small, calculated experiments with new investment approaches build skills without risking substantial capital. Embrace change. Adaptability is essential. Be willing to pivot strategies when markets shift or new data emerges. Integrating learning into daily practice. Schedule learning time. Allocate consistent time each week for study, research, and analysis. Maintain an investment journal. Document strategies, rationale, outcomes, and insights. This record reinforces learning and helps identify patterns. Attend workshops and seminars. Practical, interactive experiences provide actionable insights and allow for networking with other investors. Follow reputable sources. Curate a list of trustworthy financial experts, analysts, and thought leaders to stay informed. Apply knowledge gradually. Integrate new techniques or insights incrementally into your portfolio to test effectiveness without undue risk. Case study. Learning and adaptation in action. Consider Daniel, a mid-career investor. Early in his journey, he relied heavily on conventional stock investments. As technology and global markets evolved, Daniel began researching alternative assets, fintech, and international markets. By attending workshops, reading extensively, and experimenting in small amounts, he diversified his portfolio and increased returns. His adaptability allowed him to avoid stagnation, mitigate losses during market shifts, and capitalize on emerging opportunities. Daniel demonstrates that lifelong learning and adaptability transform an investor from reactive to proactive, consistently generating returns and managing risks effectively. Practical strategies for readers. Set learning goals. Define what skills or knowledge areas you want to develop over specific timeframes. Review and update portfolio periodically. Ensure your investment choices remain aligned with your current knowledge, market conditions, and goals. Learn from both success and failure. Analyze why a strategy worked or didn't, documenting insights to inform future decisions. Stay curious and open-minded. Avoid rigid thinking. Explore unconventional opportunities that fit your risk tolerance and objectives. Mentorship and peer accountability. Engage with communities of like-minded investors to share insights, debate strategies, and accelerate learning. Key takeaways. Continuous learning and adaptability are essential for long-term investment success. Markets evolve. Stagnation and complacency limit growth potential. Structured, strategic learning enhances confidence, decision-making, and risk management. Journaling, mentorship, and incremental application of knowledge ensure effective learning. The Perpetual Investor views wealth building as a lifelong journey, not a one-time achievement. By embracing continuous learning and adapting strategies intelligently, you solidify your path as a perpetual investor capable of sustained wealth creation, ready to navigate challenges, seize opportunities, and maintain financial independence throughout your life. Part 11. In this final part, we focus on legacy, long-term impact, and sustaining perpetual wealth across generations. The ultimate goal of mastering the inner game of wealth is not just personal financial freedom, but creating a system that preserves and grows wealth over time, ensuring that your efforts benefit future generations and create lasting impact. Thinking beyond yourself. Perpetual investors understand that wealth is more than numbers. It is a tool to secure personal freedom, support family and loved ones, invest in communities and causes, create a lasting legacy. This perspective shifts decisions from short-term gain to strategic, sustainable wealth building. Principles for sustaining wealth. Protect capital. Long-term wealth requires disciplined management, diversification, and risk mitigation. Avoid reckless speculation and prioritize preservation. Plan for succession. Estate planning, trusts, and clear directives ensure that wealth passes smoothly to the next generation without unnecessary loss or conflict. Teach financial literacy. Educating family members or successors fosters responsible stewardship, preventing wealth erosion due to poor decisions. Invest in value creation. Allocate resources toward businesses, investments, or causes that generate ongoing value, income, or societal benefit. Maintain adaptability. Economic, social, and technological shifts will occur. A perpetual investor evolves strategies to remain resilient and effective. The role of mindset in legacy. A wealthy mindset extends beyond accumulation. It emphasizes responsibility. Wealth is a resource to be managed wisely, not squandered. Vision. Seeing opportunities for long-term impact, not just short-term profit. Generosity with purpose. Using resources to empower others while aligning with your goals. Patience. Understanding that lasting influence requires time and consistent effort. This mindset ensures that wealth is preserved, nurtured, and multiplied over time. Practical steps for perpetual wealth. Document your financial vision. Clearly define your wealth goals, intended impact, and legacy priorities. Implement strong governance. Create structures to manage assets, investments, and family involvement responsibly. Diversify across generations. Ensure that wealth is allocated strategically to minimize risk and maximize opportunities for growth. Focus on education and mentorship. Develop financial literacy programs within your family or network to maintain prudent wealth management. Measure impact, not just numbers. Track both financial performance and the positive effect your wealth has on people, communities, and ventures. Case study: Perpetual Wealth in Action. Consider the Thompson family. The patriarch, a disciplined investor, consistently applied strategies of diversification, risk management, and knowledge acquisition. Beyond personal gain, he documented processes, educated heirs, and established trusts to protect assets. Over decades, wealth not only grew, but also enabled the family to invest in businesses, philanthropy, and education. Each generation benefited from both the financial resources and the mindset instilled, maintaining growth and impact long-term. The Thompsons exemplify how a perpetual approach to wealth creates sustainability and generational impact. Key takeaways: true wealth extends beyond personal freedom to include legacy, influence, and societal impact. Protecting, managing, and diversifying assets ensures sustainability. Education, mentorship, and structured governance are critical for preserving wealth across generations. A mindset of responsibility, vision, patience, and purposeful generosity supports lasting financial success. Perpetual investors prioritize long-term strategy and adaptability over short-term gratification. By applying all the principles from this audiobook, from emotional control, patience, and timing to continuous learning and strategic planning, you become a perpetual investor. Your wealth is not just a measure of personal success. It is a tool for enduring influence, freedom, and opportunity, ensuring that your efforts continue to compound and create impact for decades to come. Written and published by Mindset Masters Audiobooks.